我看到现在已经时间这么晚了，但是您在这还是这个购物需求很高啊？请问您是怎么知道我们这个周年庆活动的呢？
我看到朋友快发在现场，还有微信还有
那我们现在这个阿迪达斯店铺真的是非常多，而且还很厉害。它又这么晚了，你有觉得累吗？
有一点，但是还是觉得很值得。
您觉得我们这个氛围怎么样呢？
4周年特别拍摄现场，将近11年了，非常的找顾客来采访。快11年了，4周年
可以看到呢，现在我们已经是晚上12点了，也可以看到我们旁边这个店铺也是人非常的多。我们随机采访一位顾客朋友，我看到呢，你现在也是买了非常的多的东西，现在正在休息。我想问一下，你现在是休息一下再赞呢，还是说就回去呢？
再看看。
大家好，现在已经是9月12日，依旧是。这里是9月12日凌晨3点30分，庆奥12周年庆祝。虽然已是深夜，但是可以看到各位依然奉献卷是要放分量。那么我想这就是专注庆奥的魅力。
This is really the outline of today's sharing, and we will be going through the key investment highlights, overview of the PRC outlet market, which is the space we operate in, and an introduction to the Sasseur Group and some of our differentiating factors, as well as the financial results for the third quarter of this year, followed by an update of our capital management and portfolio, and finishing off by talking about the investment opportunity that Sasseur REIT offers to investor. And then we will conclude with the Q&A session. Next slide, the key investment highlights. Sasseur REIT was listed on the SGX in March 2018 and was the first outlet mall, or is the first outlet mall, and still is the outlet mall REIT listed in Asia. The key differentiating factor that we offer is the opportunity to invest in the high growth retail outlet sector in China, which is projected to become the world's largest in terms of sales revenue by the year 2030, 10 years away. Sasseur outlets mainly target the middle class population in China, and as we all know, this segment is also among the fastest growing in the world. Our 4 outlets malls are located in Chongqing, Bishan, near Chongqing, Hefei, and Kunming. And for those of you familiar with China, these are really some of the fastest growing cities in China. Our sponsor is Sasseur Group, and they are a reputable private outlet mall operator in China, and is a leading specialist with 13 outlet malls under management currently. Prior to operating outlet malls, Sasseur was actually a fashion distributor and a retailer, and they even have their own brand, and that provided them with a very deep understanding of the Chinese retail fashion market and the diverse and excellent brand relationship that they were able to build up over the years. Now, experience as a retailer is key to Sasseur's success, as they are knowledgeable of the entire value chain of fashion brands and the interests of the various stakeholders in the industry. It differentiates Sasseur from pure property owners or developers whose focus are really on real estate business and collecting rent, rather than on the business of retail, fashion retail. Sasseur also has the right of first refusal for 2 malls located in Xi'an and Guiyang that are owned and operated by the sponsor. The REIT is also able to acquire many properties in the pipeline which are operated but not owned by the sponsor. However, the sponsor holds the right of first refusal to this pipeline property, and in the event that they acquire it, Sasseur will in turn be granted the right of first refusal. Okay, the next slide, talking about the PRC outlet market. As compared to the outlet market in the US, outlet is a relatively young industry in China, but they have seen tremendous growth over the last decade, and they probably started only 15 years ago. Now, for example, between 2015 and 2019, the number of outlet malls which have sales more than 1 billion renminbi actually increased from 16 to 34, and continuing to grow very, very fast. Outlet malls are increasingly popular with Chinese consumers. They're really looking for value for money products, and this is especially attractive in the current challenging economic environment when people are more careful with their spending. As the saying goes, in good time people want a bargain, and in bad time people need a bargain. In addition, our outlet offer more than just shopping. They are designed and curated with a so-called what we call 1+N experiential lifestyle shopping concept to attract visitors. We'll talk more about this in the later slides. The next slide talks about the projected growth of this sector in China. What you see on the left, according to independent market research report, is that the outlet is projected to grow at 24% compound annual rate from 2016 to 2021, which is the period that the report covered. And this is higher than all the other retail segments in China, including e-commerce, incidentally. Now, the bar and center really shows a large, what they call supply gap for outlets in China, meaning there's a demand for more outlets to clear more and more inventories of branded products. The reason is what has been called the sell-through rate in the industry. In the past, merchant can generally sell like 80 out of 100 units of branded product at full retail price. The 20% that are left over are cleared at discounted price through the outlet. And this is the idea that started in the US. The sell-through rate was 80%, but because of very intense competition in recent years, the sell-through rate today is just about 50%. Therefore, what it means is that there are more and more goods that needs to be cleared at discounted prices through the outlets, and there are not enough of these good outlets. So there's a supply gap, as they call it. Now, many brands are also finding that revenue from outlets have increasingly formed an important part of their revenue sources, and have actually been producing branded product just for the outlets. And finally, on the right side, you see the outlet industry in China is mentioned. Young industry with very strong impetus for growth. The graph really shows the projected sales revenue of the China outlet industry, set to reach 640 billion RMB, or over $96 billion in 10 years. And that will mean they will take the US as the largest outlet market in the world. Next slide on the fundamentals of the industry. The three key pillars, if you like, that supports the industry in China. Firstly, the middle class population, they projected to grow at 12.1% annually from 2016 to 2021. Now, this population segment is our primary customer base and drives the growth for outlets business in China. Secondly, the rising of loans of Chinese population. This provides, of course, a strong demand for retail and also capacity to spend on shopping for branded goods. In fact, just today, there's an article in, I believe, Bloomberg that says that China, in the last 25 years, has kind of leapfrogged many countries and would almost be in the top 1/3 of the richest country in the world by GDP per capita on a PPP basis. Okay, lastly, with the economic growth and the rising of loans, last key factor, spending on luxury brands actually to mainly meet aspirational shopping needs in China will continue to be very strong. According to a report just this year, in July, Chinese consumers spent over 111 billion US dollar annually on luxury goods. And this accounts for more than 1/3 of the global industry sales. So, and then more recently with the COVID-19 and the travel restriction, this demand in fact is trapped in China. And this has in fact benefited domestic businesses, outlet business that such as Sasseur, in what phenomena some call revenge shopping. Okay, now the next slide, more on the Sasseur REIT. This slide shows a typical REIT structure in Singapore, quite common. The REIT manager is the Sasseur Asset Management. Excuse me. And our sponsor is Sasseur Cayman. The next slide, more about Sasseur Group. And as all investors in REIT knows, a strong sponsor is important. The Sasseur story actually started quite long ago, over like 30 years ago, when our chairman, gentleman Vito Shi, decided to quit his teaching job and started his own business. Initially, it was a cafe in the university, and then he went into the fashion business because where he built up knowledge and relationship with many international brand and local fashion brands, because he was an art person, art teacher, so he likes fashions and so on. Now, in 2008, he decided to build the first Sasseur outlet in Chongqing, as his hometown, and it turned out to be a big success. And therefore, he then continued to expand the outlet business across the country, and currently Sasseur manages 13 outlet malls in 12 Chinese cities. Now, the success of Sasseur obviously didn't escape some investors, so they attracted two interesting strategic shareholders, namely L. Catterton and Prudent. L. Catterton is the Pan-Asia consumer-focused private equity arm set up by LVMH. Those of you know, many of us know, it's a global French luxury product group, and Catterton, private equity of the US. And then Ping An, of course, estate, of course, is Ping An Real Estate, of course, the real estate arm of Ping An Insurance, which is among one of the world's biggest insurance company. The next slide about Sasseur Group again, more information. The company is very well recognized now in China as a brand and as an organization. Sasseur is known for its very innovative and enterprising approach to outlet business, always creating an opportunity where there are challenges. As a testament to the performance of the group over the years, Sasseur has received many awards and delivered very good results. This special, innovative, and creative Sasseur spirit, if you like, has really been a hallmark of their business success. Next slide about the super outlet business model. This is the bonus slide to understand how Sasseur business is different. They call it super outlet for a reason. As mentioned earlier, Sasseur outlet offers more than just shopping. Its unique business model is encapsulated in a formula known as 1 multiplied by A multiplied by 1 plus N multiplied by DT. What does this mean? A stands for art commerce, basically creating a beautiful destination for shoppers. You saw the picture, they look like Italian castle rather than, so-called factory type of setup. The people, visitors love to go there to actually take what they call, young people, especially Instagrammable kind of photos and shared on social media. So it attracts a lot of visitors to our outlet just for that reason. Now 1 plus N, the 1 here stands for the main business of the super outlet, which is the selling value for money, what they call products, branded products that are out of season, and represent the lifestyle activity for our shoppers. And they include lifestyle space for children, for sports, for various experiences. For example, in one of our outlets in Hefei, we actually have an indoor zoo. You can visualize it like a jewel, the concept of jewel, if you like. There's shopping, but there's really beautiful garden and things to enjoy. Sasseur started actually long ago in his first outlet on that type of concept. Now, finally, DT stands for data technology. So they use data that they collect to analyze if you like, analyze and understand the shoppers' behavior and preferences. Excuse me, and they make the changes to meet these needs. So Sasseur also uses social media and other online technology extensively to engage and reach out to its customer to promote sales. DT, of course, doesn't stand for Donald Trump, especially now that he has lost the election. The final point is Sasseur outlet are designed really to be family friendly, so as to appeal to every member of the family, encourage them to spend more time shopping. Actually, 70% of the customers are really females, but the other family members are there too. So the lifestyle activity is also to cater for the children, for the husbands, and so on. So these ideas are really to create a place for people to enjoy and also for people to stay longer. Pretty much the same way that Singapore tries to encourage tourists, which unfortunately we now have very few of, to stay longer, to spend more. The next slide on the super outlet model, again, just to summarize, it's the very unique point of this business model. It is an integrated destination, if you like, with what we call 1 plus N formula, providing popular lifestyle activity and an outlet value for money shopping, as we have explained earlier. And it obviously offer a very unique lifestyle shopping experience, as I mentioned. Only in one of its kind indoor zoo in the Hefei outlet. The many years of experience in the business means that the Sasseur had very strong brand management expertise and relationships. So this is a very much important differentiation. Number 4. The outlet, the alignment of interest with tenant through what we call a sale-based leases is also a very important differentiating point. I will talk more about that later. Basically, we don't collect rent, we collect a commission on sale. And then finally, we do have VIP members, nearly 2 million. In 4 outlets, we've been building on the loyalty program, and these VIP members contribute to a large part of our sales. Next slide on the Sasseur being a leading private outlet specialist in PRC. We have 13 outlets, and it is the leading specialist in China, and is supported by, as I mentioned, very, very important partners, L, Carrington, and Ping An. And now, of course, we have a REIT in Singapore. The Sasseur Group is really a leader in the outlet operation, brand resources, and they have a deep understanding of the local outlet market in China, and that's why they have been very successful. And it is important for the REIT, Sasseur REIT, to have a strong sponsor. The next slide, excuse me, the competitive edge against other retail segment. This is important. The slide shows the competitive advantage against other retail segment. In a sense, outlet is a unique retail asset class. It offers a discount that regular shopping mall and departmental store cannot, with the added assurance that the goods they buy at our outlets are genuine and not fake. One question that's often asked, is that, especially now with the COVID pandemic, in fact, it's how e-commerce may compete and disrupt the outlet business. I'd like to highlight that our outlets are generally not impacted by e-commerce very much for 3 main reasons. Firstly, the average transaction value of e-commerce on e-commerce platform are generally about 200 RMB, while it is about 1,000 RMB at our outlet. What it means is that the product mix are different online and at our outlet, because people generally do not buy big ticket items online. There's not a lot of overlap of customer for online and for outlet shopping, and hence it's limited cross competition. Secondly, our business model, unique. As I mentioned, we have a sale-based leases, kind of a sale-based leases kind of operation, where Sasseur outlet do not charge a rent, zero rent. Fantastic, isn't it? But they charge a commission on sales for basically the brands are selling. It's what we call 100% GTO, or gross turnover rent. Our outlet charge about 10 to 16% commission on sales. If the merchants sell their product online, they generally pay about 20% or more to the online e-commerce platform. Therefore, it means that it's better economics for them to sell their goods in our outlet. Finally, the third reason, we have very strict anti-counterfeit policy in place to protect our customers and penalize, and it penalizes our errant seller very, very severely. If a customer finds that they have been sold a counterfeit good at any of the shops at Sasseur outlet, they will be compensated 10 times their purchase value, while the tenant also pay 10 times as a penalty. Now, this measure is a very strong deterrent that ensures we have no fake sold in our outlets, and is a critical advantage over online sales that often have problem with fake products. Of course, there's the other added factor that people, when they buy branded product, do like to be able to see it, touch it, feel it. That's still an important factor. The power behind this 1+N model is that our mall offers more than just shopping. It's actually a lifestyle experience with the ability to constantly refresh, lifestyle activity as well as tenant mix. We're able to provide relevant and fresh and enjoyable experience to our customer constantly. And I've explained, our tenancy agreement is unique. Most of our leases are sales-based, particularly for the brand. Of course, some of the lifestyle activity may not be sales-based leases. Now, therefore, with these sale-based leases, what happens is that the higher tenant sales translate to higher rental for the outlet, and these really align the interests of both the landlord and tenant, and it's really important because many REITs, of course, encounter problem with this issue. Their interests not completely aligned because they would want to have to increase rent in order to increase their income. Sasseur doesn't have that model. Okay, we discuss more later. Now the next slide, which is about the Entrusted Management Agreement model, or EMA in short. This one highlights the key differentiation for Sasseur REIT. EMA model is really the first and the only one of its kind among Singapore REITs. What you see on the left shows our outlet business model. As mentioned earlier, we do not collect rent. We charge the tenants selling brands commission on sales as the rental income for our property. We call it gross revenue, as you can see in the second bar. So the higher tenant sales is the higher our rental income. And more important, this aligns the interests of the landlord and tenants, as I mentioned. It is indeed a very major pain point that we are able to avoid in our relationship with our tenant. And in the Sasseur model, there's no conflict, as I mentioned earlier, in terms of the landlord wanting to raise rent and the tenant not wanting, obviously, to have increased rent. So interest is aligned 100%. Now on the right, we have what we call the REIT income model. This is actually, as you can see, the bar represents the REIT income is split into fixed and variable component. The fixed component is contractually agreed and grows at 3% every year. And this provides stability for the REIT income, regardless of the fluctuation in sales as outlet. The variable component is calculated as a percentage of sales in each outlet, and it provides upside for investors as sales improve every year in this very high growth industry. The reason for this, of course, at the point of IPO, MAS wouldn't have allowed us to list if we had a model like this, because sales is variable, but the other income of the REIT is variable because it's pegged to the sales. Now you can see that the income model for REIT means that the REIT is paid first. Whatever is left over will be paid as what they call EM, Entrusted Management base fee, and this is kept at 30% of a gross revenue. And again, the reason here is that the expense ratio of expenditure to income for most retail REITs is about 30%. So MAS had wanted us to really have a cap, so they agreed to a 30% cap. Now, finally, if any income remains after paying the REIT and entrusted management fee, it will be split within the entrusted manager and the REIT. So the EMA model ensures alignment of interest of all parties involved: the tenant, the entrusted manager, and the REIT, or the REIT and the REIT manager, of course. And it provides more stable income and hence distribution for our unit holders, even with fluctuation in sales, as we saw recently. We had to close the mall for almost half of the quarter, first quarter, and this model proved to be beneficial because there is this fixed component that will support the income to the REIT, and we see that in the financial numbers later. So now we look at the financial numbers for the last quarter, the third quarter. First, we look at improvement in performance from last quarter, Q on Q. And the EMA rental income for the quarter, third quarter, was 30.3 million Sing. This is 8.2% higher than the second quarter this year. The distributable income has correspondingly increased 8.5% to 21.2 million Sing. Our DPU this quarter is 1.764 cent, representing an increase of 16.7% Q on Q. Now, on a year-on-year basis, our performance has essentially caught up with the pre-COVID level. The EMA rental income is only 1% below the third quarter performance last year. Our distribution per unit is in fact 7.6% higher year-on-year due to various cost saving, include lower tax provision. And we continue to distribute 100% of distributable income to our unit holders. So what it means is that we are probably one of the first, if not the first, to report year-on-year improvement following the COVID-19 pandemic that's affected many of the REITs. On the right-hand side, on the portfolio performance, our sales has recovered significantly, and occupancy remains stable at 93.1%. Our WALE, or weighted average lease expiry, is now 2.8 years, and the aggregate leverage is that's by area, by the way, and average leverage is 27.8, very conservative and leaving a lot of headroom for debt, since the leverage limit is now 50%. Next slide, the third quarter EMA rental income, as I mentioned, it increased 8.2%. This slide provides more detail, and it shows that performance has recovered pretty much to pre-COVID level. And the next slide on the balance sheet, our balance sheet remains strong. Our cash balance is 186 million, and as mentioned, the leverage is 27.8%, very conservative, giving us lots of headroom for future acquisition. The next slide on distribution, that's important. We continue to distribute 100%, as I said, and the DPU for the third quarter 1.764 cent, and the ex-dividend date is 11th of December, in time for Christmas. So this is has been quite good. One of the highest dividend quarter, if you like. Distribution history, just so that you can see the history is shown in the graph. The DPU in the third quarter of this year has exceeded last year, exceeded all the quarters, in fact. And thanks to our good recovery. In part, of course, recently we actually very actively hosted events. For example, the September anniversary sale, the largest event in the year. So this has actually boosted our sales. We're optimistic that our outlet will deliver a strong set of results, going forward, as the sales continue to improve. The next slide is just to illustrate that 8% our distribution yield really outpaced the average yield of the other REIT, which averages about 6.8%. And it ranks very well compared to other alternative investment in Singapore. In fact, Sasseur has been rated one of the REITs offering the best return, actually. And of course, also one of the REITs has provided year-on-year DPU growth in the current financial year because of the COVID pandemic disruption. Capital management, the very prudent capital management. We continue to be conservative, maintaining a ratio, as I mentioned several times already, 27.8% leverage, and interest coverage of 5.3 times. Also, we have announced in September that we have completed a refinancing exercise. This improved our Sasseur REIT loan portfolio mix and also reduced our financing costs. Our weighted average cost of debt is decreased from 4.4 last year to 4.1% following the refinancing. And going forward, we expect the weighted average cost of debt to be lower as the fee get expected into future reports. Now, our weighted average debt maturity was 2.49 years. Rather, after the refinancing, is 2.49 years with no refinancing needed in 2023. And below show the amount of loans that we have from onshore and offshore bank. A lot of data. So these are, of course, the slides are available on our website. So you may go take a look at it. The next section really talks about the portfolio, providing an update. I'll ask Ken to help and take us through on this.
Thank you very much, Anthony. Good afternoon, ladies and gentlemen. I'm Ken Chiu, the COO for Sasseur REIT. Now, for those of you who are new to us, this slide shows our portfolio summary, the location of our 4 outlet malls. Bishan and Chongqing, they are both in Greater Chongqing and Chongqing region, Chongqing near the city, and whereas Kunming Outlet Mall is based in Kunming, the provisional capital of Yunnan Province, and Hefei Outlet Mall is the provisional capital of Anhui Province in China. And the respective parameters are stated there. The total valuation is 8.2 billion RMB, based on 31st December 2019 valuation, because we do annual valuation. So the next one coming out will be December this year. Occupancy is at 93.1%, fairly stable on a portfolio basis. Now, if you look at the next slide, you can see that our sales have actually increased 32.9% compared to the second quarter of 2020 to 1.11 billion RMB. Although it's still 8.8% lower year on year. Now, this is significant because on a portfolio basis, every quarter about 1 billion it's the range that is our normal range of sales pre-COVID-19 anyways. Of this, you will see that Chongqing continued to take up about half of the total sales. More interestingly, you look at amongst the 4 outlets, if you look at the fourth column, 3Q 2020 versus 3Q 2019, the percentage differences. Chongqing had actually turned the corner. The year-on-year quarter growth is plus 2.4% versus the same period last year. Whereas Bishan, Hefei, and Kunming, although they are still in negative territory, they all closed the gap compared to 3Q and 1Q this year. So due to that, the year-to-date 2020 sales from January to September this year, it's a cumulative total of 2.48 billion RMB. Versus the same period last year, this is a drop of 28.1%. But it's a big improvement over the first Q or Q1 and Q2 cumulative result, which we announced in Q3 last quarter. Now, given the challenging environment this year, you can see that we've been recovering quite well. Outlets as a retail class has in fact been fairly resilient due to demand for value for money branded goods. That continues to be very strong. It helps that currently, due to COVID-19, cross-border movement of people are not happening by any significant margin yet. Many Chinese are not able to travel, which means increased domestic spending. I believe the figure up to last year before COVID-19 was roughly about 117 million Chinese traveling out of China every year on average, and about a spend of US $300 billion or something to that amount buying stuff overseas. So now, because they can't do it, they have to, given the travel restrictions, the good news is that they continue to spend, and so most of them they spend mostly in China as well. The Chinese government, including the local governments, have also been very active in encouraging local expenditure through various promotional measures, tax incentives, and vouchers, and so on to support the economy. So, if you look at our portfolio occupancy, you'll notice that the occupancy for home basis is 93.1, is only a drop of 0.5% compared to last quarter, so overall it's fairly stable. For Bishan, Hefei, and Kunming outlets will decline somewhat, while Chongqing outlet remain fully occupied. The reason for that, especially for Bishan, was because in September we held the annual anniversary sales for Sasseur outlets. That's the biggest sales promotion event for us throughout the year. And ramping up to September, in July and August, we actually ran a lot of the trade. We actually allowed a lot of the leases to expire and to be renewed during that period, so that we can, if necessary, move the location, request a bit more in terms of SKUs, in terms of number of products they bring in for the promotion and all that, all to make sure that our anniversary is a success. And I think the sales results spoke for themselves. So yes, there are some drop here and there in the occupancy. But first of all, that does not pose an issue for us because our sales are actually been increasing a lot and our income is tied to the sales. And secondly, that was due to the fact that we calculate occupancy taking the end month averages. So for the quarter, we take every month end and we average out, and therefore there's a somewhat drop in some of this occupancy. Otherwise, they are actually doing fairly okay. I would say that currently Bishan is doing pretty well as well, higher than 81.5% anyway. So next slide is about our weighted average lease expiry. Now, as mentioned in the previous quarter, we renewed quite a number of leases expiring then, and we continue to renew them this quarter. So the bulk of the leases that needs to be renewed has been done by September. Therefore, by gross revenue, our WALE is slightly higher at 1.1 years due to these renewals and releases. As you may know, a unique part of our business model is our leases are being kept short. The reason for that is so that we can review the tenant sales performance, the mix of tenants are based on the dynamic and always changing consumer trends. We can do that on a more frequent and regular basis. And the reason why we want to do that, take such a proactive stance, is because of alignment of interest. Our income is based largely on commission of sales. The shorter lease setup allows us to optimize our rental income on an ongoing basis as well. Now, next slide, you'll see our VIP members chart. You can see that compared to 2019, we actually have increased our membership by 3.4%. Now, we have actually stepped up online marketing and engagement with our customers, especially through the COVID-19 period. Despite all the movement restrictions and the closures of the outlet mall for 2 months, we are pleased to say that this significant increase compared to last quarter, it was 1.85 million, now it's 1.96 million as well. We actually demonstrate the special attraction of our outlets as a lifestyle destination and aspiration destination for our target middle income class customer. So on top of being a value for money destination, we are also a lifestyle aspiration. If you look at the statistics, all members contribute to about 50% of our sales, and about 50% of them comes back to our outlet malls at least once a month. So they are very sticky and very loyal to us, and therefore also very important to us. The next slide is on our trade mix. We look at the pie chart, you see that the trends generally remain the same compared to last quarter and even before the COVID-19 is the same trend. Fashion, international brands continue to make up a part of our income. And this is important because it shows that our value proposition remains unchanged. Sasseur, we are also able to differentiate ourselves through our unique e-commerce business by reviewing the performance of all our tenants closely and making constant changes to refresh our brands and good activities in our outlets. This makes sure that we continue to have the optimal mix of brands and attraction to cater to the constantly changing consumer trends. And the drivers continue to remain the same. The up and coming, the children, the sports, they are still doing well as well. Next, we have a few slides showing our malls in more detail. This is about Chongqing outlet. These are pretty self-explanatory. And also for the rest of Bishan, Hefei, and Kunming, you can see that the trend of a strong growth quarter on quarter was interrupted by the COVID-19 in the first quarter of this year. But since then, we have started recovering quickly in the second and third quarter. So this is a Kunming one. And the last one will be the Hefei. So, of course, all these slides had also been updated on our website, sasseurreit.com, and also at the SGX website as well, I believe. Yeah. So, this visual shows some of the promotional events we have done in this quarter, in the third quarter of 2020. You can see clearly that business activities has been renewed. Most people in China, the life is back to normalcy. They don't even need to wear masks. We've organized our anniversary sale in September. The turnout was very encouraging. We did midnight sales for Chongqing. Even you saw the video, even 2 o'clock, 3 o'clock in the morning, we still have a lot of people queuing outside the shop, including coach and all that, and long lines. Now, it demonstrated that the brick and mortar experiential shopping that Sasseur outlet uniquely espoused is still very much a desired essential part of the Chinese middle income class customer, which is our target customer and the largest in the world. Yep. So next, you can see that besides the anniversary sale, we also continue to review our company and products in the outlets. You can see these new key apparel brands that were introduced to Chongqing and Puchang outlets recently. We also move some of the shop to consolidate them on certain floors for better access and visuality and better general atmosphere for that area as well. So part of some of the ongoing areas we do every month. Yeah. Next, I would like to talk about a bit of our strategies to boost the outlet more sales. Some of these we have been doing on an ongoing basis, but some we actually decided to do a bit more due to the COVID-19 issue. Now, we place a lot of emphasis on digital marketing, especially since the COVID-19 outbreak. Not only that, our 1+N experiential shopping experience for the customer, active retail management through promotional events and celebration. These 3 drivers continue to perform well in helping us achieve high sales performance. Under digital marketing, we utilize various channels such as WeChat, TikTok, a few others, including some of these live auction and stuff like that, to broadcast our special promotions to our followers and the VIP members. We also analyze the customer data and their shopping pattern to improve our offerings to meet their needs, right? So for the 1+N part, I'm not sure whether I need to go further explanation, but in general, in GIFs, it simply means that we have this experiential shopping scenarios that we create has been a key feature of Sasseur outlets since day one. We don't really see that in other outlet players. We saw some of that being done in some of the traditional shopping center players who are non-outlets, and therefore they don't have the value for money destination shopping center positioning. So as Sasseur, our group constantly refresh our N+N of offerings to our customer to give them an interesting shopping experience. Examples include our 3D cinemas, one of the largest cinemas in China, the kids driving center that actually allow the kids to have fun, but also learning about traffic rules and regulations and how to obey traffic rules. And also the indoor zoo where you can have animals that fly, that swim, that run around you, and you can touch and all that. So that is fairly unique to us in that sense. Another reason why Sasseur is able to constantly attract our customer to come back and again to shop at our outlets is also our regular events and promotions. Our outlets are able to offer value for money margins with very big discounts. This incentivizes the shoppers to shop at our outlets instead of other platforms. So that is the reason why we continue to employ and deploy these strategies. So next on our potential pipeline. Next slide, please. Yeah, right. We continue to enhance our existing assets, but at the same time, Sasseur Group, our HQ sponsor, continue to expand its operational footprint, starting and operating more projects and opening them for the need. Now, we're happy to announce that in Q3 this year, the Yangzhou outlet has opened, and more recently in November, the Xiamen outlet mall has also opened. This brings the total number of outlets operated by Sasseur Group to 13, with 4 in the REIT portfolio. This expansion will therefore provide a stronger pipeline for our future growth because we either have the first right of refusal and our sponsor when they exercise their first right of refusal on the property or their call option. Also, with 13 outlets, so definitely one of the largest outlet operator. I believe we are actually the largest outlet operator in China. So we continue to be the best in class and have the largest in class and good first mover as well. I'll pass the baton back to Anthony now, who will finish off with the investment merits proposition, please.
Okay, thank you, Ken. It's quite long, so I'll try and close off quickly. Finally, we talk about Sasseur REIT growth strategy. Okay. Now, other than being well positioned in the high growth China outlet industry, as a REIT manager, we continue to grow the REIT through basically four main strategies. Number one, of course, first is in terms of very active asset management and enhancement. We actively review tenancy agreement. We enhance our properties regularly to maximize returns for the unit holders. And this year, we actually embarked on some AEI work at Chongqing and Hefei outlets. So this is continuous. Secondly, acquisition, something that we have been working on. Can't talk about it. We continue to source and evaluate potential investment opportunities that would be yield accretive, and we look out for quality outlet with good income stream. And obviously, we have a good pipeline from our sponsor, but we are also expanding our investment mandate to look at beyond China to look at any opportunity that for right assets required. Thirdly, in terms of capital management, very important. We continue to be prudent, as mentioned earlier, and we want to optimize our capital structure to constantly improve returns. And we also do, appropriate hedging strategies to mitigate market uncertainties. And finally, for marketing and communication, as we are doing right now, proactively, we continue to be transparent. I think that's a thing I emphasize to the team, to be proactive in terms of our marketing and investor relationship activity. We want to provide timely updates, on REITs to all our investors, by regularly participating in web investment webinars such as this one to engage our investors. And of course, the relevant information all on our website and then through social media platforms also like Facebook. Okay, the outlook. Next slide. For outlet in the market in China, remains very optimistic. The GDP in China's GDP and retail performance has seen very strong recovery from the since the height of the COVID-19 pandemic earlier in the year. And the outlet sector performance is resilient, and consumers have become more price sensitive and flocking to our outlet. The Chinese government has also encouraged its citizens to embrace what we call an inward-facing model of domestic consumption. What they call, interesting word, a dual circulation strategy, basically to make China more self-reliant. Given the trade tension that has occurred between China and the US, and this push to promote domestic consumption obviously helps business like ours, which are focusing on domestic customers. The next slide really is just a list of the awards we have won. We are very appreciative that we have been recognized by various magazines for our performance for our standing since the IPO 2018. And finally, just to reiterate the key value proposition for Sasseur REIT. Sasseur REIT provides exposure to the fastest growing outlet industry in China. That will be the largest in the world. Outlet is a resilient retail segment where customers purchase value for money products. Sasseur is a brand, and as an organization, is very well known in China, and as a significant enterprise, has been very successful. Our current share price offers a very attractive yield of 8%. Our 2 right of first refusal properties and 9 pipeline properties also provide a very good future growth potential for us to inject more assets. And then our EMA model really that is unique and aligns the interests of tenant, the entrusted manager, and the unit holder, and this really ensures that stable distribution to our unit holders, even if fluctuation in sales. and has proven to be very beneficial, as we've seen in the recent disruption of business. We continue to look forward to delivering good results for our unit holders, and thank you for your attention, and we're now open for questions.
What is the plan ahead on acquiring more quality assets to existing list of shopping malls in the next 1 to 3 years?
Okay, this question comes regularly. So we are working hard, so I'll let Ken answer it.
Yeah, right. I think this, it's like what Anthony said, we get this regularly, but this time I think the surprise is very specific, 1 to 3 years. I think that's a good range. I think it's definitely in the REIT's unit holders' interest if our REIT can acquire new accretive assets. So definitely we are working along those lines. So this year what we've done is we give out the team. There was some restriction because of COVID-19 on traveling and all that, but still our team is going ahead as much as we can to assess the opportunities that are opening up. Because pre-COVID-19, actually, some of these assets in more mature markets are actually not as easy to get in a price correct way, but we are seeing some changes there. So definitely, if you are saying the next 1 to 3 years, we expect some exciting times ahead. We do intend to, if possible, to acquire good quality assets on a year-to-year basis.
Thanks, Ken. So I have some questions regarding the business model of Sasseur. I combine the questions. So number one is amazingly on the 100% GTO structure. However, how would you track tenant sales? Does it go through Sasseur's payment system? And a relevant question as well is being mainly commission-based, what happened to tenants who have low sales over a long period of time? Yeah.
Okay, Ken, please.
Okay, sure. Well, I like this pigeonhole system because you can see the question as you answer them, so that helps. Now, thank you for praising us on the amazing 100% detail structure. We feel the same because there are lots of alignment of interest. Tenant sales is and the relevant data points are definitely very important. How it works is that each tenant, and just to show you the answer in short first, yes, we track the tenant sales online. So how we do is that each tenant, they have their own POS, what we call the point of sale system. And for some of the major brands as well, they have their own POS and requirements and all that. They use related service provider that can allow them to use credit card, UnionPay, WeChat, and Alipay and so on and so forth, right? On top of cash, right? So what we do is that, like what any good mall operator will do, for their POS, we actually have a third party plugged into it. Access to it, so that whatever goes through their POS, we get it online and live. So we know real time how much sales they're making every day, end of the day, part of the day, or when we do sales promotion throughout the midnight by hour if necessary. But it doesn't mean their payment system has to go through our payment system. We do not have to develop our own proprietary Sasseur payment system, which most tenants or brands they won't use anyway because they have their own system too. So what you do is that there are already a lot of solutions out there that will allow us to plug into their current costs and they allow us to track data. So we do that for all the tenants. So for the other question, which is being commission-based, meaning commission-based, what happens to tenants who have no sales over a long period of time? Now, if you recall, we kept our weighted average lease expiry, the WALE, short deliberately. So on average, by revenue is only 1.1 years. And that is exactly for the reason you mentioned here. In outlets being in the industry cycle where demand is still higher than supply, we are on a growth path. In such a case, we do not want a long lease. We want a short one so that if that happens to be a tenant with low sales, the impact is shortened. The next time, along the way, because we are fully aligned interest, we try to help them sell. But even despite that, their sales cannot increase, we will replace them from our wait list of brands and tenants wanting to come in to sell. And we will test these wait list tenants through kiosks, through some events to see whether we can really sell in a particular mall first before we replace it. So with that, we can actually get higher sales wherever we do renewal. So I hope that answers the questions.
Yeah, thank you, Ken. We have 3 questions relating to the business operation of our outlet malls. I'll read it out accordingly. Number one, is the footfall back to pre-COVID level? Number two is, what is the significance of the VIP customer? Do they get a special discount? And there's also investors who are concerning about another lockdown. So what are the risk measures taken should there be another lockdown due to the surge of COVID cases? Yeah.
Okay, I will answer in the same order. Footfall post-COVID-19, the impact of footfall was large. So even though we opened our malls, so there was a drop in footfall compared to the pre-COVID-19, but that's been recovering pretty steadily. But we did notice the interesting effect. So what happened was that our footfall was actually less compared to pre-COVID-19, and the average sales item, let's say it used to cost $100, now they are actually going slightly, average sale ticket size item is actually slightly lower, about 90% or whatever, $90. So it could be a matter of the customer going for cheaper price item, or it could also be a factor of course even higher discount post-COVID-19. At the same time, the average customer spend per customer is actually higher. So we have an interesting fact that where on per average item, the average price is lower, but they are buying more items. So that is what's happening, and that is more than making up the slightly less small decrease in footfall. So that's what we observed. That's point one. Now, as to the significance of our VIP member customers, yes, they do, as a members, they do get discount. They get more discount. So like when we do September sales, on top of the already discounted item, on top of further discount due to promotion, if you are a member for some things and all that, you can get another 10% discount or more. They get free, when they spend, they accumulate points, they use that to exchange for car park coupons, gifts and things like that, and they accumulate a certain amount of points. But there is a hurdle. You need to spend above a certain amount, usually 1,000 or 1,002, before they can sign as a member. Yeah. So what we have done so far now is that we are using WeChat membership and all that. We are actually making them all digital nowadays. So for the third question, what are the risk measures taken should there be another lockdown due to the surge of COVID cases? Okay, touch wood. In Chongqing, in Yunnan, and in Anhui province, they're all fairly safe for now. We have been tracking the numbers on a daily basis of any incidents, and I'm happy to say that there are no, in our Singapore context, there are no community cases so far. There are imported cases, but no organic community cases in these three regions in China. Because remember, China is very big. So, and we have observed what is happening elsewhere. If you recall, I think about a couple of months ago, Beijing had another outbreak, or more like community-based outbreak. So when that happened, the authorities act very, very swiftly. They got down the portion of the district that had these cases, which included distribution market and some of the residentials around it. I think like close to I hazard several hundred thousands of people were affected. But the results are also amazing because after that, no more news spread to the other districts, and then after 2 weeks, that one is cleared as well. So they are very effective because they are very experienced. They're the first mover. The virus originated in China, no doubt, but they also learn fast and they're first mover in getting all this experience and knowledge. So if the community-based spread do happen for whatever reason, there's a resurgence in any of the three regions that are at, we will work very closely with the authorities to make sure the safety of customers and the safety of our employees and related staff are ensured, like what we've done before. It's not going to be the first time. With experience, it gets even better. They already have the relevant equipment, cleaning and otherwise, to ensure the safety of customers. During the COVID-19 period, we are glad to say that as Sasseur Group as a whole, for the 40,000 direct staff and related employees or indirect employees and tenants, none of them were infected with the COVID-19 virus. We actually implement a tracking mechanism on our own initiative to make sure that everybody is okay as well. So some of these measures that we've taken, we'll continue to take them if there's any sign of a resurgence in any of these regions. So I hope that answers the question.
Okay, maybe I just add a little bit. As a REIT manager, obviously we're sitting in Singapore, and of course, Ken and his team monitors the operations in China, work actively with the ground people there. What we do here, of course, is at least at the risk management, on the risk management, our audit committee asked for a monthly report. So we're actually providing a monthly risk report, to the audit committee to make sure that we are on top of the kind of risks that we are being exposed to because of COVID-19, and all these concerns and all these what is happening on the ground is actually regularly monitored, regularly reported. So that's something that we do.
Yes.
The next question I see there is about whether it's a straightforward question, whether for the EMA base fee, is it at 30% of the gross revenue or is it variable up to 30%? It is variable up to 30%. Okay. And then the next one on EMA model, I think it says, I can't read very well, but I say fixed component at what percentage of gross revenue at IPO is 3%. That's by contract, okay? And any cap to the 3% yearly increase, there's no cap, it's over the entire period of the EMA agreement. Then the variable component based on outlet sales, what happens if the fixed component and variable component exceed the gross revenue? It would not exceed the gross revenue because the income comes from the gross revenue anyway, so that would not happen. Okay.
Right. Anthony, if I may add on for the first part of this question, SC what percent of gross revenue IPO? There's two ways to look at it, and like obviously one of the ways that the 3% growth rate for fixed component is like what you say is 3% if they ask that. But the other way you look at it is like the fixed component of the total income that the REIT gets at IPO, about how much is it? I think that figure is about roughly 70% of the IPO, during the IPO, what the REIT income is getting. So that forms about 70% at first year anyway of the fixed component of the income that is getting is fixed. But the remaining about 30% is variable on a first year basis. So
yeah, that was for the first year. Yeah, correct.
Thanks both Anthony and Ken for answering the questions. There are background questions for us. It's asking why is Sasseur REIT listed on SGX and not the other bigger markets?
Okay. But I'll try and answer that one since I was hired to do just that. In fact, 2017. If you look at and this is the XGX event, it's interesting as a question. If you look at the REIT market, Singapore is really the best place to do a REIT actually. Hong Kong, well, it's closer, to Chinese assets. The conditions are not exactly the same, in terms of the guideline for REITs. And Singapore does provide access to global investors interested in Asian real estate. So that was really the basic reason why the sponsor chose to list Sasseur REIT in Singapore. Of course, the REIT market in China is not yet started, so there's not a lot of other choices. And if you're thinking of bigger market, if you're thinking of Japan and other places, again, Japan is very much more domestically focused. And Australia is too far away. So really, Singapore is the logical choice.
Yeah, thanks, Anthony. There are some more questions on our business operation. I'll combine it and read it out. Number one is, what are the percentage of tenants who default on their lease contract? What does the turnover rate look like? Question number two is that, does the commission rate varies with trade brands or even friendship? Who has a stronger bargaining power, Sasseur or the tenant? And the last question about operation is, do you foresee any increase in expense, such as advertising or marketing?
Oh, this is a very detailed question. So Ken, you got to handle them.
Okay. I think the first part on what percentage of tenants default on their lease contract and what does the turnover rate looks like. Because we share a percentage of sales for all the brands and the fashions and all that, it's a percentage of sales. So and we collect the sales proceeds upfront. So though they use their POS system, when they charge the tenants, when the customer pay at the tenant's shop, be it by cash or whatever other means, the money, all this money actually comes to our REIT bank account. So we collect all these sales proceeds upfront, and then at the month, we spend another admin 2-3 weeks to calculate what is due to the tenants after deducting our rental based on sales commission, then we refund it back to the tenant. So in that sense, there's actually no default rate because, first of all, two things can happen. If there's no way the tenant choose not to pay the monthly rental because we collect it upfront, deduct it before we return back to them. Secondly, the closest thing I can think of is like if the tenant for some reason suddenly has zero sales, and they decide not to open shop or whatever, then based on percentage of sale, we will have nothing to collect anyway. So there's no default. But if that happens in our contract, we can either pre-terminate it because they don't open store, or because of short lease, we just churn them away and replace with other tenants. So in practice, actually, there's no default in our lease contract in terms of revenue or rental collection. Now, so that's why you notice that our model is actually the EMA model is slightly different and unique in that sense, and that applies to the turnover rate as well. The turnover rate in the traditional sense is that when we renew a tenant, if we, let's say 100 tenants, let's say if 95 of them renew, then your turnover rate is 5%, right? Because 5 of them decide not to renew. In our case, tenants stay with us because they make money. They make money because we are aligned interest, we push their sales, we help them make money, they increase their sales. So they will want to stay with us. Those who don't, the sales are not up to our expectation, we do not renew their tenancy. So it's the other way, it's more a landlord market whereby we chose to let the tenant go without renewing them, and therefore the concept is the opposite of the turnover rate. I would say that about 5% or so as well is correct in terms of turnover rate because the bottom 5% performer in terms of sale, we actually want to replace with higher sales performer, which we test them out, as I mentioned before, in the A-trend model, we see whether they can sell, then we can we replace them. So because of this replacement, you can say that turnover rate is 5%, but the whole reasoning and the whole dynamics is the opposite. It's us, the landlord, wanting to replace them. So I hope that can answer your question. Now, the next question is pretty interesting. Does the commission rate varies with trade, brand, and friendship? And who has a stronger bargaining power, the Sasseur as a landlord or tenant or operator or a tenant? In short, it's for outlet malls, it's actually a landlord market, especially for Sasseur, because we help them sell very well. Together with us, they're making more and more money. Pre-COVID-19, the average CAGR is every year is like 2-digit, 20% sales growth for all tenants on average. So that's why tenants really love going with us and opening more to support because we help them make money. And because of that, it's more a landlord market, so we take more returns. But yes, for trade and brand, the commission rate do different because if you are a Nike versus you are a local unknown, you're not really famous brand, of course it's different, right? Then you have fashion or luxury brands versus sports and children wear. Of course, the trade is also different, right? F&B, so on and so forth. So of course the commission rate is different. Friendship, no, we don't really go by friendship. So as a whole, we have benchmarks. We go by trade benchmark, but not on friendship. Just because you know someone at Sasseur, unfortunately, doesn't mean that you will get lower rates. And at the end of the day, the tenants are not that particular about 1 or 2 percentage points in commission rate. Because remember, to the tenants, what's most important? Every store is the top line sales, how much money you can earn, and bottom line cost. In terms of commission rate, between 10 to 15%, it's not high in the first place, and it's variable expense, it's not a fixed expense. So if you have those fixed plus GTO model, you can, in some cases, by month, you can actually go up to 50% of total sales and all that, which is not sustainable. In our case, it was always between 10 to 15%. So tenants do recognize that as a very good value for them, alignment of interest. It's flexible cost. The more they sell, the more they share with us. The less they sell, they also sell less. So to them, it's not a big issue. 1 or 2, if we can help them sell very well, we charge a bit more in terms of commission sales, they also don't mind too much, right? Because they're making more money. So the third thing is, do you foresee any increase in expenses such as advertising and marketing? We shared that we are going a lot more into digital social media type of marketing. Those don't really cost a lot because we're actually leveraging on our existing membership base and asking them to spread the word by giving them some points, some small gifts and all that. And so far it's proven very effective. On the other hand, in the business model side, our EMA model is structured in a way that it's like a triple net lease, whereby the operator, the Sasseur sponsor operating malls, they actually bear the property related expenses. So even if touch wood, there's an increase in advertising or marketing expenses, it's not going to be borne by the REIT, it's going to be borne by the operator. So it will be cut off from last year instead. So to us, it's not an issue at all. Yeah. I hope that answers the questions.
We have the last questions here from our beloved investors. All right, the last one is about acquisition. Given that the trading yield is high at 8%, is the REIT able to acquire yield accretive assets?
Well, obviously, the REIT has been providing excellent return to investors, and we expect that our share price should really, if you read, in fact, most analysts reporting, the target price is really 90 over cent, some even all the way to $1. So we believe that share price will move, and as share price moves, the yield obviously will correspondingly come down. It is true that at 8%, it is a bit high and challenging for us to really acquire yield accretive assets. We have been trying. So I think this is one consideration, obviously, that was not spoken, but clearly we have to be looking at yield that's slightly lower in order for us to make it easier for us to acquire. That's correct. And maybe I just go back for all the other the few key points that Ken mentioned. I think those are actually very important differentiation that's not common to other REITs. And I don't know whether in our presentation maybe we didn't highlight it. The fact that, for example, it is what they call a sales-based lease, and we collect our income upfront, so there's no default risk. And then the fact that our leases are short deliberately so that we can obviously end those that are not doing well, and then actually adjust our commission rate of those tenants that are doing well. And also the fact that it is in fact a tenant, what they call a landlord market in the outlet business. Very uncommon, because in many REITs, it's really the concern is always about making sure that you don't have vacancy and making sure that you renew tenant timely, and that you have to make sure that tenancy retention is high. Our case is actually almost the opposite, in the sense that, as Ken explained, we are in a business where many brands queue up to want to come into our outlet. Each of the outlet about 300, 400 brands, and then we have a database of probably about 1,000 over brands. But there are like 2,000 or 3,000 brands that want to go into outlet. So there's, in fact, in some way, a waiting list. So we have a happy situation of people to choose. It is actually counterintuitive. Not many people think, you tell people that this is a landlord market, most people may not be. It'll be a little cynical, but it is actually a unique business, and so a unique situation in a way because of the high growth. Okay, I'll stop there.
Yes, and if I may add on, Anthony, on this particular question on the trading yield, we can actually take a step back and consider 3 areas. First, I think you may have realized by now that Sasseur REIT is pretty unique in the sense that we have very high organic growth, even without doing acquisition. So that's why our yield, if our share price remains the same, our yield keep getting higher and higher because our DPU is increasing. So that's a good thing. In fact, our DPU is increasing so fast that to me, it seems to be like the same as some other REITs doing acquisition. They are doing inorganic acquisition so as to increase their DPU. Whereas for us, even without doing acquisition, we are already increasing our DPU very quickly. So that's one point. Now, the second point is that we believe, of course, like what Anthony shared, that over time, the share price will also increase because you keep seeing this organic growth, you're getting better and better. And so you know that in the future, you probably continue to be better as well, right? So that's why it should go. But the second point is that yield accretion. We have already stayed upfront in black and white. We only want to do projects or acquire outlet malls that are yield accretive to our units. We will not consider the situation where it's not yield accretive. So that's why at 8%, sure, fine. Are there other ways for us to do it? Look at what's been doing in the past. We have actually had done accretion. In last year, May June period, we actually acquired more short fund units in the benefit property because it's not a 100% accretion. So we can continue to do that, and obviously that adds on to a VP organic yield accretive way as well. But at the same time, the third area I'm talking about is because of the COVID-19, we are seeing that in general, the assets out there, their asking price is dropping. So that presents a window of opportunity to us, which are actively assessing. Even if our trading yield is high, it doesn't mean there are no assets that will work. Because when we acquire assets, it's a mix of the current asking price based on the NPI, which is getting higher because of COVID-19 in general. And also different markets, they have different interest costs and all that. So some of them, they are the spread is actually pretty big and therefore effective as well. Yeah, I hope these three areas make this a bit more complete. Yeah.